Any problems with that, give me a shout. But over to you, James, to start.
Yeah, so I suppose just before we start, so I'm James Brooks. I'm a divisional director here at Raymond James. We have about 60 odd branches around the UK of varying different sizes. And Jonathan Mack works for one of our branches here in London. So my role is really relationship management, sort of business development with each of our branches. One of the reasons I work quite closely with Jonathan at London Wall is they work quite extensively with intermediaries, be it IFAs, solicitors, and accountants. So as you can imagine, we've done quite a few of these sort of presentations to IFAs up and down the country over the years. So that was one of the main reasons I wanted to just get that point across, and I'll let Jonathan introduce himself as well. We've just got somebody else in the lobby, so which is Faisal. So Faisal's here. Yeah, good stuff. Hi, Faisal.
How you doing?
Yeah, good. Thank you. Yeah, we very good. We're just starting the presentation, and we've got it recorded.
Sorry about my attire.
No problem at all.
Yeah, and as James just implied, I'm one of the investment managers at Raymond James London Wall. We work with quite a few IFAs. The branch itself is managing around 260 million. Started 5 years ago, so the growth has been quite strong, but always room for more growth. And yes, the purpose of the presentation, James is going to highlight some of the key information about Raymond James as a business and the branch, how we work with IFAs, and then I'm going to talk a little bit about the market, what's going on in America and Mr. Trump, the ramifications for clients' portfolios, and then a little more detail. But as I said a moment ago, if you have got any questions, jump in at any point, make it interactive as much as we can.
Brilliant. So Raymond James. So I know Faisal well, obviously. So Faisal knows about Raymond James, but Raymond James is a company that a lot of people haven't really heard of in the UK, and we recently acquired Charles Stanley, and as you can see from those numbers, we're headquartered in the US. Big firm over there in the US. We've got 8,500 advisors, and essentially the US model came over here in 2001 and has gone from strength to strength. We run about 18.9 billion, as it says on the slide there, in the UK. Adding Charles Stanley to that takes us up north of 40 billion. Charles Stanley, who we acquired a few years ago, will ultimately currently dual brand Charles Stanley Raymond James, but we will in the coming sort of years will become Raymond James Wealth Management as a group. As I mentioned earlier, we have a number of branches across the UK, Jonathan being one. So what we tend to find is we can still offer in this competitive marketplace a very boutique, small offering, in that sense that we can be very client-centric, providing in general discretionary management services for all the typical tax wrappers that you would expect, ISA, GIA, pension, offshore bond. So it's really, I think the key thing is it's really about the fact that whilst we're backed by a big parent in the US, and we've got 40 billion in terms of assets in the UK, we can still at a local level provide that individual client service, where you actually get to speak to the investment manager who's actually running the client portfolio. So these are the sort of key areas of why you would work with one of our branches, such as Jonathan here. A lot of our branches are very entrepreneurial. We have branch principals like Jonathan, and Harry also works alongside Jonathan in this particular branch. They've got extensive experience of running portfolios and providing sort of tax optimized solutions for clients. And as I mentioned right at the start of this call, Jonathan works with lots of IFAs across the UK. So we're very good at dovetailing our services to yours to present that sort of holistic financial planning, investment management solution to the client. As you would expect, we provide all the information that you and the client would need online. Obviously, as you find with most of the probably discretionary managers you work with, less paper these days. We can still provide paper valuations and to clients, but essentially they can go online, see their valuation on a daily basis, get details of transactions, contract notes. They'll get an email alert to say, we've put some more information on your account. So we keep clients fully informed, and obviously you would get a holistic view from a sort of super user access point of view if you have multiple clients with us, and you could see all the information in one place. As you would imagine, companies such as us, we provide everything you would need when you come to us in terms of looking for investment solutions. We'd help you with any due diligence you needed to do on Raymond James. And as I mentioned earlier, you would get a dedicated team that would look after you. And Jonathan's, fully supported by our back office, who are effectively running our platform, providing Jonathan with all the kit he needs to provide the services that you and your clients would be looking for.
We can white label all the presentation packs, the review packs we do with the clients, the pitch documents that we do, all be white labeled with Julian Harris, so and make it look a bit more professional and collaborative between the two businesses.
Yeah. I think one of the key points on this slide is the first one, where we are slightly different to some of our peers. We very much operate on an introducer basis. What I mean by that is we will take all the liability away from you in terms of the investment mandate. So as you probably heard in the past, a lot of firms use a sort of agent relationship. We don't actually operate on that basis. We prefer that to work really closely with you in terms of making sure that our investment solutions align with the objectives that you're working on for the client. But the key thing is we will take your sort of fact-finding information, and we do sort of like a mini fact find, and then we would also risk profile the client, and then make sure that their risk profile aligns to the portfolio that we're building. One of the reasons for doing that is because we are still very bespoke in the nature in the way we build portfolios. So it just makes the whole process a little bit more seamless from our point of view. But also, as I say, that takes away any liability from you as an advisor and creates a clear demarcation in terms of you're providing the financial planning services, and we're providing the investment management services. So you don't need to get involved in making sure that the investment portfolio remains in line from the client's risk profile, because we will automatically be doing that. So we do find that is a lot clearer in terms of the relationship for the client, and because we'll work with you in terms of sharing data, we can speed up the onboarding process at this end. So it makes the whole process quite slick and easy from a client's point of view. So there's minimal duplication in that process.
Before I talk about research, just to sort of summarise what James has said, and hopefully Faisal would agree, how we think you can utilise us, and where we see our niche is sort of very bespoke mandates for sort of £500,000 plus clients who are looking investments in direct equities to reduce costs. We run collective only portfolios, which obviously have more cost because you have the underlying charges of the funds. But where we really feel we can benefit you as an IFA and for your larger clients is having this page that sort of shows that we have 120 equity analysts placed all across the globe, including Wall Street and Europe and London. We have third-party research from 10 of the biggest investment banks in the UK, Berenberg, JP Morgan, HSBC, just to name a few, Peel Hunt in the UK market. And we can really leverage off that, including the additional capability from the acquisition of Charles Stanley. They have a tremendous fund research team, equity analyst team, including sort of strategy guys who help with the asset allocation piece as well. So we think we've got one of the best research teams in the UK and even globally, which really plays into the hand of being able to reduce costs for the underlying client by investing in direct equities. Any questions so far on Raymond James as a business, how we operate, how we can help you guys, before I try and explain what's happening in this chaotic market at the moment. Perfect. James did a good job in answering all the questions. This market can make you look pretty silly pretty quickly. Harry and I, who work alongside, having this discussion just a couple of weeks ago about potentially investing in India, because with the higher tariffs that were implemented with China, Apple, for example, saying they're going to move their operations to India, we thought they could be a beneficiary of the trade war between the two countries. And then all of a sudden the deal, a trade agreement took place on Monday, and all of that probably gets thrown out of the window and you're back to the status quo. 2 months ago, I'd have sat here and said, what's driving the market? Inflation, global growth, monetary policy, all relatively under control. Inflation's come back down immensely from when it reached sort of 10-11% a couple of years ago. Growth was ticking along, not fantastic, but stable. And monetary policy wise, the Fed were looking to cut rates, the Bank of England were starting to cut rates. All of that got thrown out of the window on 2nd of April, Liberation Day, if that's what you want to call it. It's probably a worse day in our eyes than calling it Liberation Day. But what effectively took place was threw all of that out the window, and all of that was going to be changed by these trade wars. Inflation was going to rise probably by 2% plus, of sort of 4.5% in America, because America were going to feel the brunt of these tariffs. Their consumers. It was all of these tariffs just raised prices for all of anything they imported effectively, and then you had reactions from other trading partners whereby they were going to imply reciprocal tariffs like China. So therefore, it's going to weaken China and whoever have the reciprocal tariffs applied. That was going to disrupt growth. If the tariffs had have stuck to where they were going to be, my next slide sort of shows this quite well, I believe. We were probably going to head into a recession. So the Federal Reserve was sitting there waiting to see what happened next in terms of cutting interest rates to stop the recession happening. They haven't reacted yet, much to Trump's annoyance. And that's because they don't want to cut rates and then Trump rolls back on the tariffs and could cause a real boom in the economy, causing more inflation, because their mandate is to control inflation ultimately. Now, the reason the market reacted so badly is because on this chart on the right, we sort of expected tariffs to be in the region of sort of 7.5%, or the market did anyway. This is a chart from JP Morgan. Much higher than they have been for many years, dating back to sort of the 50s and prior. The announcement on the 2nd of April were far worse than anyone had imagined, far worse than it had ever been, even predating sort of 1940s. And where are they now? This chart was actually made prior to the agreement with China on Monday, but they're starting to come down. I think Trump was bullied by the bond market a few weeks ago when he announced the 90-day pause on the tariffs, apart from China. Basically, there's a bond auction happening in America, and the biggest buyer of bonds was the Chinese government. Actually, the UK surprisingly a third or fourth in that list of owning US debt. And what could have happened is, if no one took part in that auction, the bond yields would have jumped dramatically in America, and they needed to borrow money, and the debt payments would have increased drastically, causing a real issue in the US economy. And you can see from the chart on the left the amount of US trade policy uncertainty, how much it's jumped in recent weeks, off the chart. So I'll quickly talk about this one before moving back to the previous one. What happens next if Trump just rolls back all the tariffs, sets them up 10%? Does the economy just move on? The answer is no, because you can't. The effect he's already having on consumer sentiment, small business optimism, as shown in this chart, the blue line. The grey line is the small business optimism. You can see that's fallen. which as a result, as these are the capex intentions of businesses in the US. So the capital expenditure, i.e., if CIO is going to sit there and is he going to build a factory and spend millions of pounds at the moment in America? No, he's going to put all on hold while he sees what happens with trade wars. And that has a rippling effect on the US economy. So no matter what, he's going to have weakened the US economy because the uncertainty is caused. There's the stall of investment that's going to take place in America. This shows, I thought it was quite an interesting chart that shows US trade deficits and surpluses with trading partners in 2024. So you can see that China have a huge deficit with America, and the other end of the scale is us and Australia. We actually have a surplus with America. So what that means is we have more imports than we do exports with America of totaling 12 billion. So yes, we've got a deal with America. You can see why they've not gone after us aggressively, regardless of any special relationship we have with them, because ultimately we buy more from them than they buy from us. And they've still put a 10% tariff on us anyway. You could argue that we put a 20% tariff on them from VAT. So we've got off lightly, but for good reasons, as opposed to the top two, China and Europe. China has got a deal better than it, sort of 118% better than it was this time last week. We'll see how that plays out. It's a 90-day pause again. And he's being quite aggressive in his rhetoric towards the European Union. So we're watching to see how that plays out as well. But I mean, you could argue Trump does have a point. Look at the amount of deficits you have there. He wants to try and even that out. He's not going about the correct way, but one could argue he does have a valid point in this. These numbers on the left, the chart on the left shows GDP growth both last year and expected this year. It's all looking pretty benign, not very exciting. Most of the economies, Japan, Europe, UK, and US, sub 1, or US just creeping above 1. China, you can take that data with a pinch of salt. They say they're going to grow between 4 and 5%, and naturally they do. Whether that data coming out of there is accurate or not, I'm not sure. Their economy is slowing. They've got a real problem with their property. Effectively, they're building flats and properties in ghost towns, which cause Evergrande to go bust, their biggest property developer, causing property prices in China to fall 30% over the last few years. Now, 65% of Chinese wealth is in property, and 20% is in cash. Only 5% is in equity markets. So the consumer sentiment as a result of that property price fall has really been damaged. Now, the back in 2020, coming out of 2020, the Chinese stock market did very well. Since then, it's really faltered. It's had a bit of resurgence recently, but yeah, we're seeing how that plays out. The chart on the right shows how expensive or cheap a market is. So the grey bar is a range since 1990, with the green bar in the middle, roughly in the middle, not always in for every area, is the average, and the blue diamond shows where we are currently. So if the blue diamond is above the green bar, that is indicating that stock market is relatively expensive still. And you can see how expensive it is in relative to its range since 1990. Now, the US is still expensive for a reason. They have got the best growth companies, and you tend to have growth companies tend to be more expensive to buy because their earnings growth justifies it. Whereas the UK emerging markets, China is one of the cheapest stock markets in the world right now, bar Russia. But again, for good reason. They are going through a bit of a slowdown, and they are going to be probably most affected by this trade war with America. Again, if anyone's got any questions, jump in. I've left this slide in just interest rate expectations for the US, Eurozone, UK, and Japan. They're changing rapidly. In America, the market expected 3 rate cuts as of this time last week. They did this trade deal with China on Monday, and the market pulled that back to 1 rate cut this year. It's now digested that information, and the market is expecting 2 rate cuts. So the interest rates in America around 4.5% at the moment. 2 rate cuts brings them down to about 4% by the end of the year. This market from JP Morgan is still expecting further rate cuts next year. So a year from here, 1% of rate cuts, similar to the UK. We're at 4.25% after a rate cut last week by the Bank of England. They expect rates to be in the region of 3 and 4% over the next 2 to 3 years, whereas much lower in Europe and Japan, which obviously has an impact on mortgage rates, the economy. I've included this graph because I always get questions, how expensive are the Mag 7? Tesla is very expensive, but if you look at this line here, the PE ratio is a year out. Bar Tesla, which is trading 74 times, doesn't look that expensive. Apple's fairly expensive. Just to let you know, this is data pre the big sell-off on the 26th of February. So these have come down, even though the market's recovered somewhat. These have come down as well. So overall, if you exclude Tesla, PE ratio of these big growth stocks, big Mag 7, is trading about 24 times earnings. The same as your historic stocks like Walmart, Asda, Colgate, Starbucks, Procter & Gamble, Coca-Cola, McDonald's and Pepsi. So we're paying the same price for these Mag 7 stocks, excluding Tesla, which is more expensive, as we would for these, I would call them more boring stocks, certainly not growing anywhere near as quickly. These are growing at 20% per year. Nvidia, for example, grew at 78% last year. This is looking for next year, whereas these stocks are growing at 11%. Now, interestingly, the cash on the balance sheet of the Mag 7 is sitting at about 120 billion as of February, whereas these 7 more boring historical staple stocks are sitting on 225 billion pounds of debt. So I get asked the question, what are they too expensive? On this basis, probably not. They're the areas of the market you'd rather be in, I would say. Another question we get asked is, has the AI theme been played out already? Obviously, you've seen what's happened with Nvidia share price over the last few years. It's been very strong, which is one way to play AI. We would say no. Looking at this is a 4th wave of, the 4th computer waves, the PC internet being the first back in the sort of late 90s. We saw solid returns for 6-7 years before we saw the dot-com crash back in 2000. The mobile cloud wave, when Apple released the iPhone, and we saw mobile cloud computing take off. Returns were pretty good for 7 years then. We've only had 2 years of return from AI so far. And we put in the max drawdown of these time periods because they don't go up in a straight line. We often see drawdowns, quite aggressive drawdowns during the way up, but overall, I mean, the returns of 28% back in 2013-14 show that there's a lot left to play in the AI theme. This 4 weeks ago was a useful chart for me to show clients who were getting nervous about the market, and it shows returns after different economic and geopolitical shocks, both after 1 year, the grey bar, and 3 years being the blue bar, of a 60-40 portfolio, 60-40 meaning 60% in bonds, equities and 40% in cash. So standard, typical, medium to low risk portfolio. After each event, the Gulf War, Asian bank crisis, and so on, I won't read them all out, 9/11, probably the most scariest being the global financial crisis, Lehman default. On average, after all of these, the COVID pandemic, after all these different events, returns of the portfolio were still up 10% after 1 year and 22% after 3 years. And we've seen that recently. We've seen a 20% fall in the S&P post Trump's tariffs to almost, it's now flat for the year. So we've seen how quickly the market come back and how you need to remain in conviction with your investment process Don't get me wrong, things sometimes change and you need to reevaluate where you should be invested. But you need to stay the course, which this chart demonstrates as well. If you have nervous clients, I'll send you these charts after. You can show that what this is showing since 1980, the returns of the S&P, full year being the blue bar, and orange being intra-year. So it's very common for us to be intra-year down from the top 10% plus. Last year we was down from the top 8% at one point. The year before 10%, 25% in 2022. During COVID, at one point in March 2020, the market was off 34% from the peak. Still finished the year 16% up. So only in 2022, 2018, 2008, only sort of 4 or 5 times has the market actually stayed and remained down for the financial year, which means stay invested, keep your cool, do not sell when the market really does sell off. This shows if you had $10,000 back in 1980, the 1st of January 1980, if you put it into the S&P, if you just let it remain invested and reinvest the income, that $10,000 would now be worth 1.7 million. If you had have panicked on the worst days, sold, and as a result missed some of the best days, for example, when the market was down 8% on April 7th, it was up 10% on April 9th. If you had a panic, sold on April 7th because you thought the world was a different place and you couldn't make money in the market again because of Trump's tariffs, and missed April 9th, if you missed just the 5 best days, just from now to for the end of 2024, actually, from 1980, that 1.7 million would only be worth 1 million. So you'd have lost nearly £700,000 just from not being invested in the 5 best days in the market. And that goes on. So if you miss the best 50 days in the market, that $10,000 would only be worth $120,000, significantly lower than 1.7 million if you just remain invested and not try to trade the market day to day. Trading the market day to day doesn't work, we don't believe, and the stats prove that. You may as well go into a casino and go in red on black. 1 day returns with the S&P, yes, it's up slightly more than 50-50, but only slightly 53%. So that's saying if you invest just on 8 o'clock when you in the market and liquidate at 4:30 in the market daily, 53% of the time you'll be right. Where if you had a 10-year time horizon, the chance of positive returns is nearly 100%, 97.4%. So invest for the long term. That's all of my slides on the market, but really happy to take any questions you're getting from your clients. If we can help with that, we'd be delighted to. As I said, we will share the slides so you can use them as you wish. James will issue CPD certificates. Mo, if you could send a list of all the attendees so we could, so James can complete that for you, so you get your hours CPD for listening me drone on today. But yeah, please do. If you've got any questions, please ask them.
What's to stop the recording as well? It's all right. We're just going to stop the recording.
Already stopped.
Yeah.
Which means you